For more on the Fed's message to the markets, we want to bring in Roger Ferguson. He's the former vice chairman of the Federal Reserve, the former CEO of TIAA, and a CNBC contributor. And Roger, I think most people in the market think that we are looking at a one-and-done situation. That seems to be the message from at least several of the Fed speakers. Is that your take on things?
That's generally my take on things, Becky. And by the way, good morning. The one thing I find very interesting, and Steve just reported on, is how uniform this message is. Often when you're at a turning point, you hear some contrary voices showing that there are arguments on both sides. So I think one and done is most likely, but the uniformity and the fact that inflation is still relatively high, it may leave the possibility of a June hike on the table. I would say one and done much more likely, but not fully baked in just yet.
You do have people like Waller who have said we haven't made much progress on inflation, and then Loretta Mester who says, look, we're still looking at some high inflation, some things that are going to need to be dealt with. Is that an indication that even if they only raise rates one more time, that rates aren't coming down anytime soon? You better learn to live with these rates, because the market is kind of factoring in a cut later this year or early next year.
I think you're reading it correctly. The market, I think, is more optimistic, let's say, about Fed cuts than the Fed themselves. Obviously, the incoming data will show what actually happens. But indeed, inflation is still running well above the 2%. University of Michigan survey of consumer sentiment or expectations for inflation, showed some measures anyway that consumer expectations of inflation have actually risen. So I think the market and the Fed are certainly not in the same place around an expectation of a rate cut this year. Obviously, incoming data we'll have to prove one of those two sides wrong. But right now, I think the Fed's expecting to keep it higher for longer than the market.
It's really weird. You talk about it being an inflection period where people think the Fed's about to turn, but it's an inflection period if you're just trying to figure out what's actually happening with the economy, because you can look at numbers like American Express that shows travel and leisure spending skyrocketing still. United saying the same issue when we heard from it this week. You can also look at some areas where there are some signs of stress and some signs of slowdown and some signs of credit crunch. How long do you think it will take before we really kind of figure our way through as to where we stand?
I think it's going to take quite a while, frankly, for exactly reasons that you point out. We have some interest-sensitive sectors, housing in particular, that is already showing the strains and stresses of rising rates. We are seeing a labor market that is softening, though still not soft. As you point out, some elements of the economy are particularly strong and likely continue. And so that's one of the reasons I think the Fed is more likely to hold rates up. We aren't in a place where the entire economy is rolling over. We don't want to see that happen necessarily. But there are enough elements of strength in the economy to keep inflation well above the target for a period of time. And I think the Fed wants to really make sure that the disinflationary process is well advanced before it even starts talking about cutting rates.
Roger, you've said for a while that you think a turndown is coming, a recession. You think at this point that it's likely to be a hard landing, a soft landing? And how do you figure the credit crunch as part of all of this with the banks going through, if you want to call it a crisis, the tightening situation that they're facing?
So, yes, I have said and continue to believe that likely a recession is more likely than not. I still think it's more likely to be a softer recession as opposed to a hard one. But the credit tightening that's certainly going on, that's been talked about in the Fed Beige Book, does suggest that conditions are a little more fraught and maybe a slightly harder recession. I'm not yet in the camp that says we have a real credit crunch. I think we see some credit tightening in various places. But count me still in a sort of soft and shallow recession camp right now, but with the risk to the downside given the changing credit dynamics in the country.
Okay. Roger, thank you. Have a great weekend.
Thanks, Becky.